Last month, a retired couple in Ohio made headlines. They had saved for 40 years. They did everything right. They maxed out their 401k contributions. They lived below their means. They paid off their house. Then the husband needed heart surgery. The surgery went well, but the complications did not stop. Rehabilitation, follow-up procedures, medications, physical therapy. Within 18 months, they burned through $340,000 in medical costs that Medicare did not fully cover. Today, they are selling their home, the home where they raised their children, the home they expected to grow old in. This story is not rare. It is becoming normal. Every single day in America, retired couples face financial devastation from a single unexpected event. According to the National Council on Aging, 80% of American households with adults aged 60 and older are either financially struggling right now or at serious risk of falling into economic hardship. Let that number sink in. 80%, that is 34 million households. That is likely someone you know. That might be your parents, that might be your neighbors, that might be you. I want you to understand what at risk really means. It means one major expense away from crisis, one medical emergency, one broken hip, one extended hospital stay, one spouse dying and taking half the Social Security income with them, one market crash at the wrong moment. One of these events, and everything falls apart. Here is what nobody tells you about retirement in America. The system is designed for failure. The rules changed, the safety nets weakened, and millions of people are walking toward retirement without understanding the cliff that awaits them. Today, I'm going to show you exactly why most retirees are living on a financial cliff edge. I'm going to break down the specific numbers. I'm going to explain the hidden threats that nobody talks about. And most importantly, I am going to give you a step-by-step protection strategy that works even if you are starting late. Stay with me because later in this video, I am going to reveal the specific dollar amounts you need at different ages, the one expense that destroys more retirement plans than anything else, the Social Security trap that catches millions of Americans, and a concrete 7-step plan to protect yourself starting today. Let us get into it. The median retirement savings for Americans aged 65 to 74 is approximately $200,000. That sounds like a lot of money until you do the math. That sounds like security. That sounds like decades of planning finally paying off. It is an illusion. Let me explain why that $200,000 is not what it seems. Financial advisors use something called the safe withdrawal rate. This is the percentage of your savings you can take out each year without running out of money before you die. The rate is considered safe because it has historically survived various market conditions, including downturns. The commonly accepted rate is 4% to 5% per year. Some conservative advisors now recommend 3.5% because people are living longer. Do the calculation. 4% of $200,000 is $8,000 per year. 5% gives you $10,000 per year. 3.5% gives you $7,000 per year. That is $583 to $833 per month from your savings. Try living on that. The average Social Security benefit in 2025 is approximately $1,900 per month, or about $20,800 per year. Add that to your savings withdrawal, you're looking at $30,800 to $30,800 total annual income for someone with exactly median savings. That is $2,565 to $2,133 per month, before taxes in some cases, before healthcare premiums, before medications, before anything unexpected. Now consider this. The Elder Index, which measures basic living costs for seniors, shows that a single homeowner in good health needs approximately $24,000 annually just to cover housing, food, transportation, and healthcare. For couples, that number jumps to $36,000 or more. In expensive states like California or New York, these numbers are significantly higher. The Elder Index represents the bare minimum. Not comfort, not travel, not helping grandchildren, not going out to dinner, the minimum to survive with dignity. The margins are razor thin, one unexpected expense, one medical emergency, one market crash at the wrong time. That is all it takes to push a retiree from barely making it to not making it at all. This is not theory, this is mathematics, and the math is terrifying. Let me break down the numbers by age group so you understand exactly where you stand. These numbers come from the most comprehensive data we have on American household finances. According to the Federal Reserve's Survey of Consumer Finances, here are the median retirement savings by age. Under 35, $18,980. Ages 35 to 44, $45,000. Ages 45 to 54, $115,000. Ages 55 to 64, $185,000. Ages 65 to 74, $200,000. Ages 75 and older, $130,000. I need you to understand the difference between average and median. The average is skewed by wealthy households. A few billionaires in the data make the average look much better than reality. The median is the middle point. Half of people have more, half have less. The median tells you what typical Americans actually have, and what typical Americans have is not enough. Notice something disturbing about that last number. Savings drop from $200,000 at ages 65 to 74 to only $130,000 at age 75 and older. People are spending down their nest eggs faster than expected. They are running out. They hit retirement thinking they have enough, and within a decade they have burned through a third of it. Now here is the critical question. How much do you actually need? Financial planners often use a rule of thumb. You need 25 times your annual expenses saved for a comfortable retirement. If you spend $50,000 per year, you need $1.25 million. If you spend $60,000 per year, you need $1.5 million. Compare that to the median savings, $200,000 versus $1.25 million needed. The gap is enormous. Vanguard's 2025 retirement analysis shows that the median baby boomer faces a $9,000 annual shortfall. That means even after Social Security and savings withdrawals, they are $9,000 short of what they need to maintain their lifestyle. That is $750 per month that has to come from somewhere, every month, for the rest of their lives. Where does that $750 come from? Many people fill that gap with credit cards. According to JP Morgan research, 48% of older Americans carry credit card debt. This debt charges 20% or more in interest. This debt reduces retirement readiness by up to 40%. This debt compounds the problem instead of solving it. Others cut expenses. They stop buying medications. They skip meals. They avoid doctor visits. They live in fear of their car breaking down because they cannot afford repairs. Some tap home equity. They take out reverse mortgages. They sell their homes and downsize. They become renters in their 70s and 80s, subject to rent increases they cannot control. You see the problem. People enter retirement already behind. Then they dig the hole deeper with debt. Then one shock hits, and everything collapses. This is how the 80% become financially struggling or at risk. What is that shock? What is the single biggest threat to your retirement security? Healthcare. This is where I am going to give you numbers that will make you uncomfortable. Numbers that might make you angry. But you need to hear them because healthcare costs are the number one destroyer of retirement plans in America. Most people know healthcare is expensive. They do not know how expensive. They do not know how fast costs are rising. They do not know what Medicare does and does not cover. Fidelity estimates that a 65-year-old couple retiring in 2025 will need approximately $315,000 to cover healthcare costs in retirement. Other studies put this figure as high as $300,000 to $350,000 for a couple. Think about that. The median couple has $200,000 saved total. They need $315,000 just for healthcare. Before housing, before food, before utilities, before everything else. And here is what makes this even worse. That $315,000 figure does not include long-term care. Let me say that again because people miss this all the time. That $315,000 is for regular medical expenses only. Doctor visits, prescriptions, hospital stays, lab tests, surgeries, specialist appointments. It does not cover what happens if you need someone to help you eat, bathe, or get dressed every day. Medicare covers a lot. People assume it covers everything. It does not. Medicare Part A covers hospital stays. It has deductibles. The 2025 Part A deductible is over $1,600 per hospital stay. If you're in the hospital multiple times in a year, you pay that multiple times. Medicare Part B covers outpatient services and doctor visits. You pay 20% of most services with no annual cap. If you have a $100,000 cancer treatment, you owe $20,000. There is no maximum out-of-pocket limit on Part B. Medicare Part D covers prescriptions. It has its own deductibles and copays. Expensive medications can cost thousands per month, even with coverage. And none of Medicare, not Part A, not Part B, not Part D, covers long-term care. According to Genworth's 2024 Cost of Care Survey, here are the current annual costs for long-term care. Nursing home private room, $127, the minimum is $150 per year. Nursing home semi-private room, $111,325 per year. Assisted living facility, $70,800 per year. Home health aid, $77,792 per year. Homemaker services, $75,500 Warhouse per year. Adult daycare, $26,000 per year. These costs increased 7% to 10% in just 1 year, not 7% over a decade. 7% to 10% in 12 months. They are rising faster than general inflation. They are rising faster than typical investment returns. They are rising faster than Social Security cost of living adjustments. In some states, these costs are dramatically higher. In New York, nursing home care averages $159,000 per year. In Alaska, over $400 per day for a private room. In California, major cities see nursing homes charging $12,000 to $15,000 per month. Research shows that 70% of people who reach age 65 will need some form of long-term care in their lifetime. This is not a rare event. This is the majority of people, 7 out of 10. If you reach 65, you will probably need long-term care eventually. Most people do not know this. Most people do not plan for it. Most people assume they will die peacefully in their sleep and never need help. The statistics say otherwise. Medicare does not cover long-term care. Let me repeat this because it is so important and so widely misunderstood. Medicare is health insurance for seniors. It covers medical treatment. It does not cover custodial care, meaning help with activities of daily living like bathing, dressing, eating, and moving around. The nursing home when you cannot take care of yourself anymore, not covered. The National Council on Aging found that 60% of older Americans cannot afford even 2 years of in-home care. 2 years, not 10 years, 2 years. And the average long-term care need lasts 3 years. Many people need 5 years or more. Some need a decade or longer. This is the cliff. This is the one step away from financial disaster. One diagnosis of Alzheimer's, one stroke, one fall that breaks a hip, one Parkinson's diagnosis, and decades of saving vanishes in months. Everything you worked for, gone. There is another threat that does not get enough attention. It is called longevity risk. The risk of living too long. That sounds strange. Living long sounds like a blessing. You get more time with family, more time to enjoy life, more time to pursue hobbies and interests. Financially, it can be a curse. Every year you live in retirement is a year you need to fund. Every year your savings must generate income. Every year inflation erodes your purchasing power. Every year healthcare costs can spike. Life expectancy data shows that if you reach age 65, women can expect to live another 21.1 years on average. Men can expect another 18 years. That means planning for retirement until age 86 for women and 83 for men. But those are averages. Half of people live longer than average. That is what average means. If you are in good health at 65, if you do not smoke, if you maintain a healthy weight, if your parents lived long lives, you could easily live to 90, or 95, or longer. Here is the problem. If you plan for 20 years of retirement and you live 30 years, you run out of money during the last decade of your life. The decade when you are most likely to need expensive medical care. The decade when you are most likely to need long-term care. The decade when you are least able to go back to work. Running out of money at 75 is terrible. Running out at 90 is worse. At 75 you might be able to work part-time. You might be able to move in with family. You have options even if they are not good options. At 90, your options are Medicaid or family support. Period. The 2025 EBRI Retirement Confidence Survey found that 39% of workers fear outliving their savings. BlackRock's research shows that 2/3 of retirees worry about running out of money, up 10% from previous years. The fear is growing because people are starting to understand the math. The Natixis Global Retirement Index revealed something shocking. 46% of working adults believe they will need a miracle to achieve a secure retirement. Nearly half of working people think divine intervention is their best retirement plan. That number rises to 23% even among current retirees, people who have already retired, people who should have clarity about their financial situation. Nearly a quarter of them think they need a miracle to make it. This is not pessimism, this is people doing the math and realizing the numbers do not add up. Think about what that means. These are not people who never saved. Many of them did save, many of them did plan. But life expectancy increased faster than expected. Healthcare costs rose faster than expected. Investment returns did not meet projections. Inflation spiked. And suddenly, the plan that looked solid 20 years ago has holes you could drive a truck through. This is not a planning problem. This is a systemic crisis. Let me explain why this crisis exists. Let me show you the structural failures that created this mess. Because this is not about personal responsibility alone. Yes, people should save more. Yes, people should plan better. But the system itself is broken. First, traditional pensions have nearly disappeared. Only about 15% of private sector workers have access to a defined benefit pension plan. In the 1980s, that number was over 38%. In the 1950s and 1960s, pensions were standard at large companies. A pension guaranteed income for life. Your employer made the investments, your employer took the risk. You worked 30 years and you received 60% of your final salary every year until you died. Simple, reliable, safe. Companies hated pensions. Pensions created liabilities on the balance sheet. Pensions were expensive when people started living longer. Pensions made earnings unpredictable, so companies shifted the retirement risk from themselves to you. They replaced guaranteed pensions with 401k plans. Now you are responsible for deciding how much to save. You are responsible for choosing investments. You are responsible for managing withdrawals. You are responsible for not running out. Most people have no training in investment management. Most people have no idea how to construct a retirement income plan. Most people make emotional decisions and buy high and sell low. The 401k was never designed to be the primary retirement vehicle. It was created as a supplement to pensions, a way for executives to shelter extra money from taxes. It became the main retirement plan because it was cheap for employers. Second, wages have not kept pace with costs. Housing costs have exploded. Healthcare costs have skyrocketed. Education costs have surged. The EBRI survey found that 81% of workers say Rising living expenses prevent them from saving enough for retirement. You cannot save what you do not have. In 1980, the median home price was about 3 times median household income. Today, it is more than 5 times in many markets. In expensive cities, it is 8 to 10 times. Healthcare costs have risen faster than general inflation for 50 consecutive years. Wages have not. The squeeze is real. People are not failing to save because they are buying lattes and avocado toast. They are failing to save because their rent takes 40% of their income. Their healthcare premiums take another 15%. Their student loans take 10%. What is left for retirement? Not enough. Third, debt burdens have increased. For workers, debt interferes with saving for 51%. Baby boomers carry higher debt-to-net worth ratios than any previous generation at the same age. This was supposed to be the wealthy generation. They are the most indebted retirees in history. Student loans for themselves or their children, mortgages that extend into retirement, car payments that never end, credit cards to fill the monthly gaps. Every dollar that goes to debt service is a dollar that cannot be saved. Every dollar of interest is wealth transferred to banks instead of retirement accounts. Fourth, financial literacy is low. The Transamerica survey found that 47% of workers are just guessing when they estimate how much they need for retirement. They are not calculating. They are not running projections. They are not modeling scenarios. They pick a number that sounds good, maybe $1 million, because it is a nice round number, and hope for the best. Financial education is not taught in most schools. Employers offer 401k plans, but not training on how to use them. Advisors are available, but they often charge fees that eat into returns or sell products that pay them commissions. The result? People make preventable mistakes. They cash out retirement accounts when changing jobs. They invest too conservatively when young. They invest too aggressively when old. They panic sell during downturns. They fail to rebalance. They do not understand fees. Fifth, access to workplace retirement plans is unequal. Economic Innovation Group research shows that 78.7% of the lowest-earning workers lack access to any employer retirement plan. If your employer does not offer a 401k, you are dramatically less likely to save. The automatic payroll deduction makes saving easy. Without it, saving requires active effort every single month. Vanguard found that 54% of workers with plan access are on track for retirement, compared to only 28% without access. Access nearly doubles your odds of being prepared. But access depends on where you work, not whether you need a retirement plan. Small businesses often do not offer plans. Low-wage employers often do not offer plans. The people who can least afford to fall behind are the ones denied the tools to keep up. This creates a cascading effect. Low wages lead to low savings. Low savings lead to reliance on Social Security. Reliance on Social Security creates vulnerability to policy changes, and the cycle continues. Speaking of Social Security, let me address the elephant in the room. Because Social Security is both the lifeline and the ticking time bomb for American retirees. Here is the reality. For millions of people, Social Security is not a supplement. It is the majority of their retirement income. It is the difference between eating and not eating, between having shelter and being homeless. The Social Security Administration projects that the trust fund reserves could be depleted by 2033 to 2035. That is not a political talking point. That is the official projection from the agency that runs the program. What happens when the trust fund runs out? The program does not disappear. But without congressional action, benefits could be cut automatically to match incoming payroll tax revenue. That means cuts of 20% to 25% across the board. Bankrate's 2025 survey found that 72% of non-retired adults worry that Social Security will not be there for them or will be significantly reduced. This fear is based on real math. Now, I want to be clear about something. Social Security is not going to disappear completely. Politicians who claim the program will vanish are fear-mongering. Even in the worst-case scenario, there will still be incoming payroll taxes to fund about 75% to 80% of scheduled benefits. The system is partially funded by current workers paying for current retirees. As long as people work and pay taxes, there will be Social Security. But a 20% to 25% cut to someone already struggling would be devastating. Remember those thin margins we discussed? For many retirees, Social Security is 70% or more of their income. A 20% cut to their main income source is not an inconvenience. It is not a belt tightening. It is a catastrophe. Imagine your monthly income drops from $2,000 to $1,600. Can you absorb that? Can your parents? Currently, 94% of retirees receive Social Security income, and 73% consider it a major income source. These are not wealthy people using Social Security as a bonus. These are not people with large pensions and investment portfolios who appreciate the extra check. These are people who need every dollar of that payment to pay rent, buy food, and keep the lights on. Congress could fix this problem, raising the payroll tax cap, increasing the retirement age gradually, adjusting benefit formulas. There are solutions. But Congress has known about this problem for decades and has not acted. Betting your retirement security on Congress acting responsibly and promptly is not a bet I would take. Now I need to talk about the wealth gap in retirement, because this crisis does not affect everyone equally. Look at the data by wealth quintile, meaning we divide everyone into 5 groups from poorest to wealthiest. The bottom 20% of households aged 60 and older have zero net worth or negative net worth. They owe more than they own. Their median income is $18,000 per year. The next 20% have about $35,000 in total wealth. That includes their home. The middle 20% have about $149,000 in total wealth. The fourth quintile has about $396,000. The top 20% has over $1.9 million. Here is what that means for life expectancy. Adults in the bottom wealth quintiles die 9 years earlier than those in the top quintile. Financial insecurity does not just reduce quality of life, it shortens life itself. Mortality rates are nearly double in the bottom 60% compared to the top 20%. Being poor in retirement is not just difficult, it is deadly. Women face this crisis more severely than men. The OECD reports a 26% gender pension gap globally. Women over 65 receive significantly less retirement income than men. Why? Several reasons compound each other. Women earn less during their working years. The pay gap reduces how much they can save. Women take more career breaks for caregiving, children, parents, spouses. Those breaks mean fewer years of contributions to Social Security and retirement accounts. Women work part-time more often. Part-time workers frequently do not qualify for employer retirement plans. Women live longer than men by about 3 years on average. Longer life means retirement savings must stretch further. The result? Women accumulate 30% to 40% less in retirement savings than men. Single women over 65 face poverty rates of 19% compared to 7% for men. If you're a woman watching this, you need to plan more aggressively. The system is stacked against you. I promised you actionable advice. Here it is. This is your protection strategy, whether you are 30 or 60. Step 1. Calculate your actual number. Stop guessing. 47% of people guess their retirement needs. Do not be one of them. Here is the formula. Take your current annual expenses. Multiply by 25. That is roughly what you need saved if you plan to withdraw 4% per year. If you spend $50,000 per year now, you need $1,025 million saved. If you spend $40,000 per year, you need $1 million. Then subtract expected Social Security income multiplied by 25. If you expect $20,000 per year from Social Security, that is $500,000 you do not need to save. Your target becomes clearer. $1,025 million needed minus $500,000 from Social Security equals $750,000 you must save. This is not perfect math. It does not account for inflation, healthcare spikes, or taxes, but it is vastly better than guessing. Step 2. Build an emergency fund separate from your retirement savings. Median emergency savings for Americans is only $5,000. 41% have less than that. 17% have nothing. Your emergency fund should be 6 to 12 months of expenses. Keep it in a high-yield savings account, not invested. This money is insurance. It keeps you from raiding your retirement accounts when the unexpected happens. 34% of workers have already dipped into retirement accounts for emergencies like medical bills or debt payoff. Every dollar you take out is a dollar that cannot compound. Every early withdrawal comes with taxes and penalties. An emergency fund prevents this disaster. Step 3. Eliminate debt before retirement. Debt in retirement is a weight that drowns you. Every monthly payment reduces what you have for living expenses. Every interest charge steals from your future. Attack high-interest debt first. Credit cards, personal loans, then car payments. Then consider whether you can pay off your mortgage. A retired person with no debt has far more flexibility than someone with $2,000 per month in payments. Your $30,000 annual income feels very different when you owe nothing. Step 4. Plan specifically for healthcare. This is where most people fail. They do not account for healthcare costs separately. Open a health savings account if you have a high-deductible health plan. HSA contributions are tax-deductible. Growth is tax-free. Withdrawals for medical expenses are tax-free. After age 65, you can use HSA funds for any purpose. You just pay income tax on non-medical withdrawals. Max out your HSA every year. In 2025, limits are $450 for individuals and $8,300 for families. Over age 55, add another $1,000. An HSA is the most tax-advantaged account that exists. It gives you triple tax benefits. Use it. Additionally, research Medicare supplement plans and Medicare Advantage plans. Original Medicare has gaps. Part A covers hospitals but has deductibles. Part B covers doctors but has 20% coinsurance with no cap. You need supplemental coverage. Budget at least $300 to $400 per month per person for Medicare premiums and supplemental coverage. More if you want comprehensive protection. Step 5. Create guaranteed income streams. The Protected Retirement Income and Planning Alliance found that 64% of retirees are interested in annuities for guaranteed income. There is a reason for this interest. Social Security is guaranteed income. If you have a pension, that is guaranteed income. Everything else depends on investment returns and how long you live. Consider using a portion of your savings, perhaps 25% to 40%, to purchase an income annuity. A single premium immediate annuity converts a lump sum into monthly payments for life. You cannot outlive it. This is not right for everyone. Annuities have fees. They reduce flexibility. But for someone terrified of running out of money, guaranteed income provides peace of mind that investments cannot match. At minimum, delay Social Security as long as possible. Every year you delay past 62, your benefit increases approximately 7% to 8% per year, up to age 70. That is a guaranteed return you cannot get anywhere else. Step 6. Plan for long-term care. This is the hardest step. It is also the most important. You have 3 options. Option 1, self-insure. This requires significant assets, typically $500,000 or more, dedicated to potential long-term care needs. Most people cannot do this. Option 2, long-term care insurance. Purchase a policy in your 50s or early 60s when premiums are lower and you can still qualify medically. Policies typically cover nursing home stays, assisted living, and home care up to daily limits. Option 3, hybrid life insurance with long-term care benefits. These policies provide a death benefit but allow you to access funds for long-term care if needed. They cost more than pure life insurance but provide flexibility. Do not assume Medicaid will cover you. Medicaid requires you to spend down nearly all your assets first. You must become poor to qualify. That is not a plan. That is failure. Step 7. Diversify your retirement income sources. Do not rely on one source. Social Security can be cut. Pensions can fail. Investments can lose value. The most resilient retirees have multiple streams: Social Security, pensions or annuities, dividends from investments, rental income, part-time work income. Each stream insulates you from problems with the others. If the stock market crashes, Social Security still arrives. If Social Security gets cut, your rental property still generates income. Start building these streams now. Buy dividend-paying stocks. Consider real estate. Develop skills that could generate part-time income in retirement. Let me address some objections I know you are thinking. I'm too old to fix this. No, you are not. Every dollar you save now is a dollar you have later. Every debt you pay off is a payment you do not make in retirement. Every year you delay Social Security increases your benefit by 8%. If you are 60 with $50,000 saved, you cannot reach $1 million. But you can reach $150,000 by 67 if you save aggressively. You can pay off your mortgage. You can delay Social Security to 70. You can buy a small annuity for $50,000 that guarantees $300 per month for life. Small improvements matter enormously when margins are thin. I cannot afford to save more. Then you need to make more or spend less. There is no third option. Look at your budget ruthlessly. Subscriptions you do not use, cars you could downsize, housing you could shrink. Every expense is a choice. Consider a side income, freelance work, consulting in your field, rental income from a spare room. 25% of retirees plan to work part-time. Start building that income source before you need it. Social Security will be enough. The average Social Security benefit is $1,900 per month. Could you live on that? Really? In your city? With your health conditions? Paying for Medicare premiums and supplemental insurance? Social Security was never designed to be your only income. It was designed to be one leg of a three-legged stool: Social Security, employer pensions, and personal savings. Two of those legs have weakened for most people. The stool falls over. The government will fix this. Maybe, eventually. But you cannot bet your retirement on political action. The Social Security Trust Fund has been heading toward depletion for decades. Congress has not fixed it. Prepare as if no one will rescue you. If they do, wonderful. If they do not, you survive anyway. Here is what I want you to take away from this video. 80% of Americans over 60 are financially struggling or at risk. Do not be one of them. The threats are real: healthcare costs, longevity risk, Social Security uncertainty, market volatility, inflation. These solutions are specific. Calculate your number, build emergency savings, eliminate debt, plan for healthcare with an HSA and supplemental insurance, create guaranteed income through delayed Social Security and annuities, plan for long-term care, diversify income streams. You cannot control the economy. You cannot control Washington. You cannot control whether you get sick. You can control whether you plan. You can control how much you save. You can control whether you are one step from disaster or 10 steps away. Start today. Not tomorrow. Not next month. Today. Because the couple in Ohio who lost everything, they thought they had time too. If this video helped you understand retirement risks better, share it with someone who needs to hear it. A parent, a sibling, a friend approaching retirement. Financial security is not just about you, it is about the people who depend on you, the people who would have to support you if you ran out. Knowledge is protection. Spread it. I will see you in the next video.